If you're running a business, there's one thing you can do right now to make yourself more successful and your company more profitable. Now, I trust that you're smart, you're hardworking, you're ambitious, you have a ton of energy, you put that into your company, but guess what? All of these things combined aren't going to help you to achieve your full potential unless you overcome this one gap. Now, I'm going to explain what that gap is here in just 1 minute, but before I do so, let me just say this. When I go into a company, my team and I, one of the first things we do is we conduct a performance health check. We do this by looking at the income statement, the balance sheet, the statement of cash flows. We also look at historical performance of the business. We compute ratios. We look at key performance indicators. We benchmark the company, and we do all this to compile a story that we can present back to the leadership team to say, hey, look, here are your gaps, here are your constraints, and this is your path forward to driving greater value in your business. We have to understand the story behind the numbers. But it's during this time and during the interviews that we conduct with the leadership team that we realize there's a massive gap in them knowing their numbers. And that's what I want to talk about today is knowing your numbers, because that will make all the difference in the world. I'm not talking about being a nerd and understanding all the debits and credits of your company or being able to map out a general ledger in your accounting system. I'm not talking about that. I'm just talking about basic numbers in your business that pertain to your role in what you're doing. So if you're listening to this and you're a business development manager, maybe you're a frontline worker, maybe you're the COO, maybe you're the chief legal officer. It doesn't matter which role you're playing in your business, you can know your numbers related to your job. And that's very, very important. So there are 8 things that I'm going to ask you. Okay, I'm going to quiz you on these 8 things. Now, guess what? There's no shame. There's no judgment had. So if you don't know these things, there's no need to feel bad. This is just an invitation for you to know your numbers and to start measuring what matters, because what gets measured gets managed. And I always say, if you don't measure it, you don't care about it. So if you start measuring what matters, I guarantee you performance will improve. It'll make all the difference in the world. Okay, so let's dive into these 8 things. The first thing I'm going to ask you pertains to your sales and marketing effectiveness. And this is measured through a ratio called LTV to CAC. LTV stands for lifetime value of a customer, and CAC represents customer acquisition cost. Now there's a nuance here, because out there in the world, LTV is commonly used, but it's also commonly misused and misunderstood, because people believe that LTV is the revenue or the lifetime revenue that is generated by one customer. But that's not true. LTV, I prefer to call it LTGP, which stands for lifetime gross profit of a customer, because think about it. Sure, you can generate revenue from a customer, but you also have to fulfill the products and services that you are delivering to them, you're selling to them, and therefore you have to account for those costs. That's why I think revenue minus those costs, which equals gross profit, is a better measure, LTGP. So I like to look at LTGP compared to CAC. CAC stands for customer acquisition cost. You can find customer acquisition cost by adding up all the costs associated with bringing on a new customer. Sales and marketing, business development, advertising, paid ads, everything you're doing related to sales and marketing, add up all those costs and then divide it by the number of new customers you bring in for the year, and that will give you your CAC. So LTGP compared to CAC, a good starting point is 3, but don't stop there. The best-in-class companies have a 20-to-1 or even higher ratio as it pertains to this one metric. But that's the first question I have for you. Do you know what your LTGP to CAC ratio is? And if you don't, now you know how to find it. Number 2 is revenue retention. In other words, how much of your revenue is retained year over year based on a certain population or customer set in your business. So here's how to find it. If you pull a sales by customer report year over year, and you just go to last year, look at all the customers that did business with you, okay? Add up all that revenue with that customer set. Then compare that same exact customer set to the next year, to the current year. And then just take your current year revenue from that exact same set divided by the revenue generated by that same population. In other words, if you have 4 customers, A, B, C, and D in 1 year, and they generate $1 million in revenue for you, and then you look at the revenue generated from A, B, C, and D again in the current year, You can't add E, F, G, H, I, J, right? The new customers you picked up in the current year. Just look at the same customers year over year. And then let's just say A, B, C, and D do $800,000 with you in the current year. 800,000 divided by a million from last year equals 80%. And that will give you your revenue retention. This is how much revenue you retain year over year from your customer base. Now, if that number is below 80%, that's not good. All right, that means that you have high churn. But regardless, this is one of the metrics you should know. And if you do know it, thumbs up. Okay, that's a bonus point for you because most companies don't know this number, but it's really, really important because think about it. Let's say you have a revenue retention rate of 60%. That means every single year you have to go make up 40% of that revenue by acquiring new customers. And this ratio goes hand in hand with your LTGP to CAC, because if you have a low LTGP to CAC ratio, guess what? It's going to be more and more expensive to replace these customers that are churning. So those are two ratios that would be helpful to know. The next ratio I want to talk about is your gross profit margin. Do you know what your gross profit margin is? You can find this by taking your revenue minus your cost of goods sold. That will give you gross profit. Then take this dollar amount and divide it by your revenue, divide it by your sales, and that will give you your gross profit as a percentage of revenue. Now, this number varies widely from company to company and industry to industry, but I would just say a good starting point is a gross profit margin of 40% or higher. Now, it all depends how much overhead you have down below. In other words, you may have a 20% gross profit margin, but your overhead may be like 2%, right? Or you may have a 60% gross margin, but you have an overhead of 50%. And if this is the case, it just means that you're gonna have less profit because your gross margin's high, but your costs are also high, so you get squeezed out between the two. Regardless of all this, knowing what your gross profit margin is really important because this will help you to understand how effective is your company at selling a product or service at a certain price and then fulfilling that product and service and then making a profit off that spread. So that's the third metric you should know is your gross profit margin. Number 4 is your break-even revenue. Do you know how much revenue or how much you need to do in sales each year in order to break even? You find this by taking your overhead expenses, your SG&A or your OpEx, and dividing this number by your gross profit percentage or your gross margin percentage, same thing. This will tell you what your break-even revenue is, and this is really important, especially when you're setting sales goals or when you're setting that bottom baseline for how much you need to do each year before you start generating a bottom line profit. Number 5 is your average contract value. Now, if you are selling contracts to customers, or maybe you're selling orders or whatever it is, whatever the denomination is, understanding what the value is per transaction with each customer is really important, because then you could take the number of transactions, the number of orders, the number of contracts, or whatever you are selling to your customer, multiplied by this average price, and then you can figure out what your revenue is. So it's very formulaic, but understanding what is the average order, average contract, average transaction of your business is really critical. Number 6 is what I call throughput. Now, throughput can be measured in a variety of ways. The best way to measure throughput is your gross margin per hour or some variation thereof. But oftentimes gross margin is a lagging indicator and it's hard to measure in real time. So I will just go to revenue per hour. So that's the 6th thing that I want to ask you about. Do you know what your revenue per hour is? Now, here's the trick when it comes to computing your hours, your denominator. I like to use hours that come from employees who are doing direct or indirect work related to fulfilling products and services. In other words, I like to take the hours from the labor that's up in cost of goods sold. You could take total hours worked by all employees of your organization, but instead, I like to look at the hours that are related to people actually delivering the products and services to customers. So if you take the total revenue of your company divided by the total number of productive, direct, indirect hours, whatever it is, related to fulfilling that revenue, then you'll figure out what your throughput is. And this will help you to understand the efficiency of your workforce. I could do a whole episode on throughput alone, but that's a good starting point. And then from there, you can do gross margin per hour or net operating profit per hour or whatever it is, but just start with revenue per hour. Number 7 is understanding your free cash flow. Do you know how much free cash flow your company generates on a month-by-month basis? You could also look at free cash flow as a percentage of revenue. And this is really critical because profit does not equal cash flow. And 70% of companies that go bankrupt are profitable when they close their doors because they run out of cash. They don't have cash. So taking your profit and then accounting for your working capital and your capital expenditures will ultimately get you down to free cash flow. You could also go to your statement of cash flows and take cash from operating activities and subtract out capital expenditures, and that will get you to free cash flow. However you get there, taking free cash flow and looking at it as a percentage of revenue, like I was saying, or in just nominal terms and just dollar terms and month over month is going to be a really important thing to understand. So make sure you know what your free cash flow is. Now, the last thing I'll quiz you on is your return on invested capital. And if you know this, kudos to you. That's extra credit because most companies don't track this, but it's really important. It's pretty easy to find. You just take your net operating profit after tax, all right, and then you divide it by your invested capital. Invested capital is the combination of your working capital, current assets minus current liabilities, plus your net property, plant, and equipment. All right, you can find those things on the balance sheet. Those combined equal your invested capital. That is your denominator. Your numerator is net operating profit after tax. Just do the math there and you'll find your return on invested capital. This number is important because unlike your profit margin, which just tells you how much profit you earn as a percentage of your revenue, return on invested capital tells you how much operating profit after tax you're earning based on your invested capital. Or in other words, how much money is invested in your business to drive operations, and it'll help you to understand your returns. So if you have a return on invested capital of 10%, that means you're pretty much matching the equity market. Because if you go invest in stocks, over time, your return on investment is going to be around 10%. So if you're just earning 10%, great, you're staying in parity with the market. If your return on invested capital is below that, like some companies, they may have a return on invested capital of 2%. I'm like, why do you go through all the headache? You just take all your cash out of your business and go put it in a money market account. It's a lot less work. Now, I'm being facetious here. Don't do that, obviously, in your business unless you're ready to give up. Instead, if you understand how much you're actually returning on your capital, all the money you have in your business, you may make better or different decisions in your company. All right, those are the 8 measures that I wanted to test you on. There's so many different measures in your business. Some of these may pertain to your specific role. Some of them may not. The point is knowing your numbers. So if I were to come into your company and I said, okay, what's your customer acquisition cost? And you're like, I don't know. All right, how much do you spend on sales and marketing a year? I don't know. Now, you don't need to be like super precise. Like, oh yeah, we spend $1,342.85 cents. You don't need to go there. But instead, you should be like, yeah, our customer acquisition cost is about $215. Our LTGP to CAC is 15 to 1. Our growth rate is 32% year over year. Our EBITDA margin is 42%, whatever it may be, right? But being able to spit these numbers off the top of your head is really important. And you'll get there. Trust me. If it seems overwhelming right now, like I get it, right? I was there once too. But when you start measuring what matters, these things will stick in your head and you'll be able to spout them out, especially when you speak with other people in your organization about numbers and your company becomes more numbers oriented. And when you're using data to make better decisions, guess what? Your strategy is going to launch you forward because you have a strong strategy and you'll understand what the true measures of success in your business are, and you'll just drive continuous improvement. All right, if you need help with any of this or you want to hop on a one-on-one strategy call, you can do that by going to coltivar.com. I'll provide some information in the description below. But thank you so much for joining me today. And if you found value out of this, please be sure to share. And until next time, take care of yourself. Cheers.